Hello, I am George Rodriguez, a senior business manager in Latin America and founder of kPaGold, a consultancy focused on helping industrial and chemical companies turn market potential into sustainable and profitable growth. For many years, when I heard expansion plans from chemical companies, the script was almost always the same. We are going to grow in China, consolidate our presence in Europe, and strengthen our portfolio in the US. In some cases, there would be a chapter on Latin America or India, but almost as an appendix. But the most recent data shows that this map has changed. An ICIS analysis with 5 forecasts for the chemical market in 2026 makes this very clear. First, because China is moving quickly on its self-sufficiency agenda. The country has been adding capacity in various chemicals and polymers, domestic demand has slowed, and the result is a trend towards higher exports in chains where many global producers used to count on China as a major buyer. Second, because the signs of stronger growth are coming from somewhere else, the so-called developing world ex-China, India, Africa, Turkey, and Latin America, is beginning to take on the role of the new engine of demand. In parallel, global reports indicate that the world chemical market is expected to grow from around 5.3 to 5.7 trillion US dollars in 2025/26 to more than 7.5 trillion US dollars by 2030, driven by industrialization, infrastructure expansion, agriculture, energy, consumer goods, and an increasing focus on green chemicals and higher value-added products. In other words, the pie is growing, but the most interesting slices are not necessarily in the same obvious markets as before. As a senior director, when I look at this scenario, the question that comes to mind is not only how much will the market grow, but rather in which geographies and segments does it make sense to invest capital and capacity over the next few years. Let us organize this thinking into 4 blocks. První, what is changing in the geography of the chemical market? Druhý, which emerging markets are the priority ones? Třetí, how to translate this into a practical expansion strategy? Čtvrtý, the pros and cons of this agenda for chemical companies and distributors. Pátý, what is changing in the geography of the chemical market? The ICIS report speaks of 5 forecasts, but 2 of them are particularly critical in defining priority markets. The first is the continuation of China's self-sufficiency strategy. After years of heavy investment in capacity, combined with a context of weaker demand due to factors such as the property slowdown and demographic challenges, the country is moving towards becoming a net exporter in several products, including polypropylene and other important chains. For those who previously saw China as the market that absorbs everything, this means more intense competition and fewer opportunities in basic chemicals. The second is the shift in growth focus towards the developing world ex-China, a grouping that includes India, countries in Southeast Asia, Africa, Turkey, and Latin America. With more than 5 billion people collectively, these markets present a powerful combination of urbanization, industrialization, population growth, and infrastructure needs, all vectors that are highly chemical intensive. At the same time, global analyses show a chemical market growing at rates of 6 to 7% per year between 2025 and 2030, driven by demand in sectors such as construction, agriculture, personal care, and energy, with an emphasis on specialties, performance chemicals, and sustainable solutions. In other words, the future is not only about more volume, it is about more value added in emerging geographies. První, emerging priority markets for chemical expansion. If the question is where to go, the data suggests 3 priority blocks. First block, India and emerging Asia, ex-China. India appears with a strong outlook for GDP growth, industrialization, and petrochemical demand, including as a highlight in analyses of the chemical sector in Asia. Market reports indicate significant expansion in various chains such as construction chemicals, oil and gas, agrochemicals, and high-value specialties. In addition, the reconfiguration of global supply chains itself, with companies seeking to reduce exclusive dependence on China, tends to strengthen India and Southeast Asia as manufacturing and consumption hubs, generating additional demand for chemicals. Second block, Latin America. In Latin America, we see some very clear levers. The regional crop protection chemicals market is estimated at around 16 billion US dollars in 2025 and is expected to reach more than 24 billion US dollars by 2034, with a CAGR of around 4.5% from 2026 onwards, with Brazil dominating the share. The The chemical distribution market in Latin America is valued at approximately $25.8 billion in 2024 and is projected to exceed $36 billion by 2031, signaling strong room for consolidation and for higher value-added distribution models. Recent analyses highlight that the Latin American chemical sector has significant growth potential, but faces competitiveness challenges against global players and pressure from imports, which open space for differentiated strategies in service, logistics, and specialties. From the point of view of a chemical company or distributor, this places Brazil, Mexico, and some Andean markets as a natural priority in the region, especially in segments linked to agriculture, construction, oil and gas, sanitation, and higher value-added consumer goods. Third block, Africa and other emerging markets. Global analyses indicate that Africa and parts of the Middle East should gain prominence as destinations for chemical demand driven by population growth, urbanization, and investment in basic infrastructure. These are markets which, in many cases, depend heavily on imports, which favors players with reliable supply capability, logistics risk management, and an adapted portfolio. První, how to translate this into a practical expansion strategy? Looking at the map is the beginning. Turning it into an executable strategy is what separates a nice presentation from real growth. As a senior business director, I like to work on 3 layers. Layer 1, where to play, selecting priority markets. Based on the data, it makes sense to prioritize. 1 to 2 anchor markets in emerging Asia, for example India, and 1 key country in Southeast Asia. 1 to 2 anchor markets in Latin America, for example, Brazil and 1 other, Mexico, Chile or Colombia, depending on the portfolio. 1 to 2 entry markets in Africa, taking advantage of logistics hubs and affinity with specific segments such as mining, construction and agriculture. This choice should consider market size, growth, level of imports, regulatory environment, and fit with the company's portfolio. Layer 2, how to enter, presence model. The answer is not always to build a plant. In many cases, the smartest initial steps involve strengthening partnerships with local distributors who already know the customer base and the regulatory environment, setting up regional warehousing and blending hubs, reducing lead time and raising service levels without immediately taking on heavy production capex, structuring regional technical and commercial teams focused on strategic segments, for example, crop protection, construction, oil and gas, and personal care, in order to differentiate through application, not only through price. Layer 3, what to compete in, portfolio prioritization. The reports show that the most attractive growth is not in basics with overcapacity, but in specialties, performance chemicals, and sustainable solutions. This includes additives and specialties for agriculture, food, cosmetics, oil and gas, and construction. Solutions linked to sustainability and circularity, such as chemicals for recycling, inputs for renewable energy, and materials with a lower carbon footprint. In practice, this means that for many players, the expansion focus in priority markets should be less about commodity volume and more about a mix of products and services that solve specific pains of local customers. První, pros and cons of this agenda for chemical companies and distributors. The pros are clear. Structural growth. You position yourself in markets that, over the next 10 to 15 years, are likely to grow above the global average. Dependence on imports. In India, Latin America and Africa, the need for imports across several chains is still high, which opens room for reliable and consistent suppliers. Room for differentiation. Less consolidated markets allow you to build a leadership position based on service, proximity, innovation, and the ability to navigate local regulation. On the other hand, there are downsides that a senior director cannot ignore. Macroeconomic and political risk. Currency volatility, changes in government, evolving regulatory frameworks, and bureaucracy may affect predictability of returns. Regulatory complexity in chemicals. Especially in Latin America, the regulatory agenda is becoming more demanding, with discussions around registration, classification, transport, and use, requiring more robust compliance and institutional relations teams. Growing global competition. With China and other players seeking space in ex-China markets, competition is likely to be intense, including on price. In summary, the move towards priority markets such as India, Latin America, and Africa is not a cosmetic option. It is a medium and long-term strategic decision that requires appetite for risk, local execution capability, and capital discipline. If you lead a chemical company or distributor, the question I leave you with is Is your expansion map updated to this new geography of growth, or is it still stuck in the old centers of gravity? The capital you invest over the next 3 to 5 years can position you on the main avenue of future growth, or leave you overexposed in saturated markets. I am George Rodriguez, a senior business manager in Latin America, and at kPaGold our focus is precisely on supporting leaders in the chemical and industrial sectors to prioritize markets, entry models, and portfolios in a pragmatic way, connecting global strategy to the reality of local execution.